Welcome to Restaurant Deal Making Exposed, the only show that equips you with everything you need to know about restaurant transactions. In this show, we tell you all about how to make the sale or purchase of your restaurant not just possible, but successful. Now here are your hosts, ex-restaurateurs and seasoned brokers, Patrick Toda and Andy Mirabel.
All right, welcome everybody. Another episode of Restaurant Deal Making Exposed. I'm Andy, my partner Patrick's here. This episode's called SBA Now. We are really lucky to have Scott Cisneros on with us today. Scott Cisneros is vastly experienced in the lending world and currently is a senior loan officer for City National Bank. He's an expert on SBA 7A loans, business acquisitions, partial changes of ownership or partner buyouts, or owner-occupied commercial real estate. And that is the kind of deal I've done with Scott in the past in San Francisco. He also holds a real estate license, which adds value to commercial real estate transactions, ensuring a comprehensive, client-focused approach that aligns with the strategic objectives of the clients he serves. Many of our listeners may already know that getting a bank or SBA funding for a restaurant is not easy. It's not easy to obtain, and given the high failure rate of restaurants, it makes it that much harder. There are also many economic constraints as well as government cutbacks or policies that can affect the SBA lending process or willingness to lend. Scott is and always has been a great support and wealth of knowledge for new and longtime brokers alike. He always tells it straight, and in my experience, he is a priceless resource for me and so many other agents within restaurant realty. Scott will always pick up my call right away and answer emails about the lendability of a business quickly and efficiently. He has a loyal following for good reason, and he is very active within the California Association of Business Brokers as a lender and an expert. City National Bank, where Scott is a loan officer, has a goal to deliver exceptional customer service and to transform the challenging financing landscapes into successful opportunities for our clients. Scott's role at City National Bank revolves around crafting specialized SBA lending solutions that foster the growth and expansion of small to medium-sized enterprises. His team excels in navigating complex credit analysis to secure funding for business acquisitions and so much more. I'm going to plug Scott here and let you guys know that whether you're applying for a loan, needing funding for a business purchase, whatever it may be, or just have questions about the process and or City National, he's always a wealth of knowledge. So his contact information I'm going to share with you. So get your pen and paper out now. And you can also reach out to Patrick and I as an email if you need Scott's contact information. Scott can be reached at 916-765-9443. His email is Scott, SCOTT.CISNEROS @CNB.com. Okay, let's bring things back to our restaurant niche and discuss SBA restaurant lending, the current SBA lending trends and challenges, and what Scott forecasts for 2026 and beyond. So welcome, Scott. We're really happy to have you and that you're using your valuable time to be here on Restaurant Deal Making Exposed.
No, I appreciate the kind words that could have been coming from my mother, which is a good thing. So hey, thank you so much.
I was wishing he could say some nice things about me like that sometimes.
Not a chance, Patrick. And your mother's a very lucky mom. You're a good guy, Scott. You're so good at what you do. So you've seen me when I got into this industry, and I hope you've seen some level of evolution, but you've been helped me along the way with so many questions, and I've used a lot of your time for free, unfortunately.
I love talking SBA, talking deals, structure. I mean, if I could be busy all day long, obviously I want to get some deals done, but I enjoy talking deals. And so again, always amazed when people don't pick up their phone, because that's what I'm paid to do. And so, I'm blessed. I love what I do. There's no plans to retire. I tell my wife, you're going to hear a thud, and that's going to be me being done. I fell out of the chair and I'm done.
Wow. Well, see, I told you guys he's a straight shooter, right? There we go. Yeah.
No
Patrick, that's a good segue for you, Patrick, right?
For sure. So, Scott, why don't you give us a quick, brief, what are the big difference between SBA lending and conventional lending?
So, majority of lenders will use SBA, especially for a business acquisition. One, Andy brought it up, is the risk involved with business acquisitions, change of ownerships, restaurants included in there, because the SBA gives a 75% guarantee. And so that's one of the frustrating parts with SBA lending. People are frustrated on why does it take so long or why is it so hard? Well, the bank has to make sure that they do everything right, because when, per se, the business fails in 3 years, 5 years, 7 years, the SBA will go through and rip that credit file apart, making sure you did everything right. And so that's why we got to cross our T's and dot our I's in the beginning to make sure that, again, the deal is good if we ever have to call in the guarantee. And so that's why the majority of banks will use the SBA financing. Is it's a 75% guarantee that just limits the amount of risk that the bank can do.
It's accountability is what you're talking about. You've done your vetting as a loan officer that you've really, like you said, dotted all the I's, crossed the T's on vetting this deal before you actually move into the application process and beyond with funding, right?
As a bank in general, and me specifically, I know my credit officer well enough. I know my credit guidelines for my bank. If I submit a deal and it gets declined, I feel like I missed something. I should have vetted this well enough, been able to put a structure in place that was going to work, or passed on it before we even go through the process of going down the road of submitting a deal. But once we get a deal in and get it, through credit, then yeah, it's really a matter of crossing your T's, dotting your I's, making sure that you're following the SBA SOP, so that if you got to call into question the guarantee, it's a good loan.
Yeah. So, and then on the SBA pre-approval process, when I can write a listing and it has a pre-approval, what does that exactly mean? And does that mean that the business, from a perception standpoint, it looks like, hey, SBA is willing to loan on this, so that means that it should be a good business for me to buy?
Correct. So I always preferred to do the pre-qualification on the business versus the borrower, because again, what I will do is get the financials, historic financials. That's what we're going after. Look at the business, look at the price, look at to say, hey, based on this price, here is what the new loan payment's going to be. Can the business in essence support that new payment? Because in a lot of cases, there's little to no debt on some of these businesses. So you're picking up a big SBA loan there. Can it cover that? The part of the equation, obviously, I don't have is the buyer. And so that's where the introduction comes in to say, do these two things go together?
I have a question then. If I'm a young, which I was, but not anymore, a young, energetic guy, restaurateur wanting to go out and find my first brick and mortar, and I have a huge qualification. I have a lot of qualifications, experience. I have the down payment cash, and maybe I own a house and some assets. Can I come to you, Scott, as the applicant and say, here's who I am. Can I get a pre-approval?
You can. I struggle a little bit with pre-approvals from the applicant's side, because I don't know what business you're going to go buy. Now, if you want to say to me, hey, to your point, Andy, I'm a restaurateur, I'm looking for a restaurant, that is a much better, pre-qualification from a buyer standpoint than sometimes a blanket, hey, I've got $100,000 for down payment and maybe a home with some equity. What business can I buy?
Exactly.
I don't know, because experience plays such an important factor.
We should really earmark that for our listeners. Experience is paramount in this application process. And it's become more important, I believe, over the past years. It seems that from other lenders.
Scott, I get clients who, grew up in the restaurant business, but, hey, they've been doing tech for the last 10 years. Where does that experience growing up land with you?
I think it really depends on then the size of the business, because I've experienced that as well, Patrick. You got people that just entrepreneurials are in their blood, their dad, their grandpa, their cousins, everybody owns businesses. And to your point, they went into tech because tech seems to be at least around in Northern California. A lot of people come out of tech. They're just sick of the grind. I would say it's going to depend on the size of the business you're looking at. As you get bigger loan-wise, that tends to be a bigger business, bigger restaurant, much more complicated. And so that comes into play greatly into what, are you going to be able to qualify for a smaller $750 million versus a $5 million business? There's much more complexities that normally come along with a bigger restaurant Are you talking about multiple locations,
Sure.
hundreds of employees? That I think is where it comes into play to say, are you going to be able to do this? And what help are you bringing in? Are you bringing in relatives that are going to be on the loan with you and help you? Or is it just going to be you?
Yeah. And so is that at your discretion or is that at SBA's discretion?
So most lenders are what we call PLP lenders, meaning we underwrite to a specific SBA guideline. We don't go to the SBA and say, Mother, may I? We know what their guidelines are and we underwrite to them. And again, that's where the crossing the T's and dotting the I's come into place. Now, a lot of credit is what I would call subjective, meaning, does my credit officer think you have the experience, the knowledge to be able to run and manage this business? There isn't a specific SBA guideline that says, hey, you have to have this and this. Direct industry experience is always the best, but you could have come out of high tech. You've managed certain profit and loss statements, had a huge amount of employees under you that you managed. Does that translate to the business you're looking? If I can make that argument successfully, then it's a deal we're going to get done. So it's all about, can I successfully make that argument?
Yeah. Patrick, I know from our standpoint as a broker saying why we want these pre-approval letters attached to our listing. I mean, it makes the shiny new car shinier, or the second generation restaurant shinier looking as a listing. It's a bonus for us to have that. It broadens our buyer pool.
When I bought my first restaurant, I went and found a restaurant at what price I could afford at the time. And I would probably now, with the knowledge that I have, I would probably turn that around. I would probably buy a restaurant that I can get an SBA loan on and put the same amount down and buy an extremely profitable restaurant, right? Like instead of buying a restaurant for $200,000 and then, turning it into the concept of your dreams, why not buy a restaurant for what $200,000 can get you as a down payment and buy, strong SDE? That is probably the lesson I've learned over the years of being a business broker that I would probably do. And that goes to your question about, pre-approval, right? Like looking for businesses with a SBA pre-approval is a great way to probably find the right business for you if you're not tied to a specific concept and more tied to finding a successful business.
Yeah, that's been vetted by multiple eyes, including brokers, lenders, and so on.
Yeah, no, I would say sometimes the hard part from the buyer standpoint is what size business now can support you financially? Because I'm sorry, if you are looking at buying a business for $500,000, great side hustle, very hard to live off of on paper. And so what does that look like in terms of your needs? Because if you tell me you're coming out of Apple and you've got a, big house payment, 2 Range Rover payments, kids in private school, you can't quit Apple and then go buy a $500,000 yogurt shop.
Yeah.
It just doesn't work.
Well
But
said.
I think sometimes buyers haven't thought that deeply into it to say, the bank can't set you up for failure. If you can't pay your bills, we're going to look at this from a global aspect of, how are you going to pay your bills with this business? And does this make sense?
Yeah. Gotta have the debt service work there. I've definitely been in a situation where what you just described is true, that someone just wants to get out of the industry. They want something a little more different, maybe more simple, but the revenue and the profits from this business does not support their lifestyle. So my question then goes to, which I feel like I've been through, is there's a spouse. The spouse has a very healthy income, and the total family income is really what gets it over the hump. Am I accurate on that to some extent?
You hit the nail on the head. Those are the partnerships to me in my mind that work. You've got 2 people, again, not to use too much on Apple, but I seem to see a lot of people coming out of Apple. Wife or husband, they're keeping that really high paying job. The other half is going to be more entrepreneurial, wants to go buy a business. That equation together is just gold. I mean, it is what every SBA lender is looking for.
Got it. Good. I think it'd be good for our listeners, Patrick. What do you think? Just to touch on timelines of this stuff, because it seems the application process from start to finish is very nuanced, complex, and there can be delays and stuff. But maybe we can touch on the general timelines for each of these things, Scott.
If everything runs perfect and you are dealing with a straight business acquisition with no real estate, 45 to 60 days, you should be able to get a deal done. If everybody's engaged, everybody's trying hard to get this deal done, 45, 60 days is a doable timeline.
Is that from when they submit their application to you?
Yes, that would be from submission to funding. We could get a deal done between 45 and 60 days if everybody is working together.
Wow.
And that would be like 60 days would be like for a business with an ABC license, getting the unconditional funding letter and then having to wait for the ABC license transfer.
Correct. With anything ABC, you know as well as I do, we can get you the funding, the unconditional funding letter, but it still might take, 3 or 4 more weeks to actually get the license transferred and be ready to close. It would be more getting it docs to escrow is 45 to 60 days in most cases. Now, as you guys know, landlords play a big role in this. To your point, ABC plays a big role in it. Those are the ones that are a little bit outside of our control. For my bank, underwriting is taking about 2 weeks. Underwriting a deal, we get a good submission in underwriting. I should be able to have a yes or no decision within 2 weeks. Then I put it back on the buyer to say, okay, here are all my conditions. How long does it take you to get life insurance if it's required? Get the lease nailed down, get all your insurances in play, your license, anything required to operate that business. Then it's on the buyer to say, how long is it going to take you to do this? At that point, I'm just collecting data and then working towards a close.
Scott, I hope everyone can hear that how detail oriented you are and that you're not going to give a thumbs up to a pre-approval or an application if you don't think it's going to get to the finish line. But as in industry, like let's generalize the industry a little bit. How many deals that are given a conditional funding letter make it to getting funded?
From my standpoint, from my bank, I would say 97%.
Woo,
if we've gone through credit, I give you a conditional commitment letter. The only way those deals don't get done is buyer or seller pulls out. For some reason, they don't want to proceed. It's not from the bank's point of view. We give a conditional funding letter. We're going to fund that loan unless, again, something dramatically goes wrong.
Got it. That's cool. Great. Thank you for that. So let's dive into a little bit of what we've experienced this year. 2025, from my perspective, and I'm pretty confident from a lot of other brokers and agents, it was a really wonky year. It really had its ups and downs. And I had really high hopes in the beginning, and then I had really long lulls, and I had a lot of cautious buyers, emotional buyers, more so than normal with everything going on for many reasons. But then I start digging in a little bit more. And it seems to me, probably what I'm reading and researching, that overall 2025 has been a very strong year, or will turn out to be a very strong year for lending from the SBA standpoint, which was a little bit of a surprise for me that it's above and beyond 2024 or is on track to be above and beyond. And the other factor, Scott, that I was surprised is that a lot of the 2025 volume is driven by smaller loans under $150,000. So tell me if this is accurate or what your take is on that.
Yeah, I mean, for me, 2025 was the second best year I've ever had when it comes to volume.
Wow. Congratulations.
Great year. Thank you. But it was probably the hardest year I've ever had. To your point, everything was hard. There wasn't a simple deal to be had. It was just a struggle from the beginning to the very end. And so it wasn't without a lot of hard work to get there, but it was hard. I would say it depends on the bank and what they're using SBA funding for. There are a lot of banks that do a lot of smaller SBA loans. On the business acquisition side, smaller loans are much harder than bigger loans. I think it's just the level of experience, the level of knowledge, the partners that are involved when it comes to financial advisors, CPAs, attorneys. They help smooth out the process on a bigger loan. Smaller loans just don't have that. And so $150,000 SBA loan is 10 times harder than a $1.5 million SBA loan, which doesn't seem realistic, but it is.
A lot of these smaller loans, then, are many of them, for example, a purchase for a business or working capital or other things like this. It's not necessarily for buying another business.
Yeah, I mean, I think a lot of them are working capital. To buy a business for $150,000, a lot of people don't know the SBA wants to be the lender of last resort. They call it credit elsewhere. So there's a test that says if you could get this financing elsewhere, you need to get the financing elsewhere. And so on a smaller deal, sometimes that's a home equity line of credit, it's a seller carry, or it's a cash deal. As you know, it's hard to get an SBA loan. So why are you going to jump through those hoops if you don't have to, if you've got other means of getting that money?
You brought up seller carry, and that's an interesting one. I can understand on paper why the lender would like to see a seller willing to carry a note or a partial note for the transaction, because it exudes faith in the business and operations that they're selling, that they're confident it will continue on and be profitable. But can you tell me how that works with debt service and how the total equation works for you? If the lender is getting an SBA loan and the seller is carrying 25% of the purchase price, it still has to all work out as far as the applicant, or the buyer being able to cover debt service to pay both of those loans, right?
Correct. So the way that most banks look at it is we are looking at what are the loan payments on my loan? What are the loan payments on the seller carry note? Putting those all together. And that is the total, debt service coverage, that's included in the debt service coverage. What is sometimes painful on a seller carry note is an SBA loan will go out 10 years. Most seller notes don't want to go out 10 years, and I get it.
Yeah.
So those bigger seller carry payments can sometimes be a deal killer for that, to say, dude, it just doesn't debt service anymore if the seller wants to get paid back in 3 years. So sometimes we'll come back and say, hey, I know we submitted it 3 years. How about 5 years, 6 years, 7 years? We got to push out these payments because it just doesn't work. The business can't support the debt service coverage with a 3-year repayment.
And on that seller note, the seller note would be subordinate to the SBA debt. Is that correct?
Correct. The SBA always wants to be in first position on everything. And sometimes that's where a large seller carry note may be bigger than the SBA. That just doesn't work anymore, because why would the seller want to do that?
Yeah.
Because the SBA doesn't care. Yeah. We want to be in first position no matter what.
Scott, totally hypothetical question here. What if you didn't know as the lender that the buyer and seller had worked out a little deal on the side outside of their application to cover $100,000 to bring down purchase price and make the equation work better for the bank? I mean, this is not something I would ever recommend. It's not ethical, but is this something, have you heard of situations like this? I've heard this in discussions, so that's why I'm asking.
I've heard this a lot. And again, to your point, what the SBA lender, the bank doesn't know, I can't control that. I don't know what's happening after close, after, escrow, after all of that, because these deals are 10-year long. In essence, the bank just really wants to get repaid. That's what we're doing. And so, again, sometimes it's the don't ask, don't tell kind of mentality, but it just, that's what reality is.
That's funny. And here's another example that's a less egregious. You put a stamp of approval on Mary's, matzo ball restaurant, and you think it's a great business and you pre-approved it. But the buyer comes in and says, well, I want to open Andy's family restaurant, right? And they go in, but they need to take over Mary's the current concept as is, learn it and take over. But in the future, their intent is actually to change the concept. And that's another don't ask, don't tell sort of situation, correct?
Absolutely. Because again, plans change, things change. They may get in there and they were going to do that in 6 months. Maybe it's more complicated or harder than they thought. And that ends up being a 3, 4, 5 year down the road thing. Well, don't kill your deal because you thought it was going to be in 3 months and it ends up being in 5 years. Again, it's hard for us to control what we don't know is going to happen in years to come.
Yeah. Scott, what percentage of your deals are restaurants, and how many of those deals do you see a seller carry? Just curious.
I would say in general, I probably do more restaurant deals than maybe my bank would like. I would say I do upwards, probably 40% of my deals are restaurant deals. We are again looking for those stronger deals, the good experienced operators, outside collateral deals. So we're not doing the sketchy kind of restaurant deals. So we don't lose very many deals either, which again, knock on wood is good, but we probably do more deals than my bank would normally like to see. But those are the deals I'm getting and those are the deals I'm presenting.
It's a higher number than I would have expected.
Yeah, 40% is high.
Yeah.
Yeah.
So has in 2025 or with the, policy changes and stuff, has it been a stricter lending environment this year as compared to previous years?
I would say for my bank, no, but we weren't the way far out on a limb lender. Anyways, those lenders for the most part are gone at this point. The SBA, again, a lot of people don't realize, is a self-funding government program. SBA charges guarantee fees. Those fees go to the SBA to run the program, cover losses. Well, during the pandemic, they weren't charging guarantee fees on loans under $1 million. Well, statistically, 80% of the loans the SBA does are under $1 million. No guarantee fees, 80% of your revenue. That isn't a program that can sustain itself for an extended period of time. We got through the pandemic, new administration, they had to make changes. So all SBA loans right now carry guarantee fees. They had to do it. The losses were mounting. Those, I think, have been pared back to an extent because we're just getting back to doing good lending. Is it a good deal? And those are, I think, the lenders that are still standing. We're just getting back to doing good deals.
With the elevated rates for the loan, I think that put people back on their heels a little bit. Do you feel the applicants kind of softening on this? Obviously, rates are coming down incrementally, but was there a pretty hefty impact initially where you just saw a really hard stop on the applications for a while when the rates were at their peak?
I did a lot of refinances this year, to your point, where deals that had been done 3, 4, 5 years ago that were on variable rate deals. My bank will do fixed rate deals. And so I did see a lot of refinancing to be able to get into more of a fixed rate product. I think from the industry standpoint, the most deals have always been variable rate deals. They're prime based, prime plus a margin. That's where the majority of lenders sit. My bank's a little bit of an outlier there, but I think people just started looking a little bit more. The deals had to make a little bit more sense because of the higher interest rates. The payments were bigger. I think, again, it just stressed those subpar deals just couldn't get financed with the higher interest rates.
Where are we right now with the interest rate? If I wanted to get a loan on a business, what is the range? And then I hear that this week the Fed is going to be lowering the interest rate again. And how long does that take to kind of affect on your side for the business loans to be affected by that?
again, in general terms, most SBA lenders are lending off of prime with a margin. I would say prime plus two in most cases is considered a pretty good rate. So prime right now at 7.25. You're looking at 9.25 on a variable rate. That range can be then prime two, upwards of prime 2.25, 2.75, excuse me. That's where most lenders are sitting. Once the SBA says we're going to lower rates, that instantaneously goes into effect. So common thought is prime is going to go down to 7%. So now you're looking at rates at 9 to 9.75. Again, I'm a little bit of an outlier. We price off the 10-year treasury. So 10-year treasury today is 3.98. For me, a deal over $1 million, I'd be 10-year treasury plus 3.75. So my rate today is 7.33. So fixed for the 10-year term, but I am looking for stronger borrowers, stronger deals. So they're deals that can get done on a variable rate deal that my bank won't do. And I try and figure out real fast, is this a deal my bank can get done? So I don't want to be a deal killer or take anybody down a road. I just can't get a deal done.
Yeah. I mean, and I think that speaks to who you are and your approach. And I think that's a win-win for both sides. So that's wonderful. I was surprised to see that food service was one of the industries that showed a lot of growth in loan approvals this year. Given all the hurdles that restaurateurs deal with and a lot of the curveballs with cost of goods, labor shortages, I can go on, right? That our industry actually had growth in loan approvals. Are those loan approvals, again, you've been pounding this down our throat in a good way, Scott, that you're looking for good deals that make sense. But is there any part of our restaurant world that stands out more than the next part, such as quick service restaurants that are doing all this, delivery or third party app stuff? But does one sliver of the pie stand out more as lendable?
I mean, when you look at those businesses during the pandemic, anything pizza related, delivery, they just killed it. I mean, you're seeing revenues drop, not because it's a bad business. It's just they were doing so well during the pandemic. They've come back down to pre-pandemic levels. I think you're seeing a lot of change because the pandemic was hard. You had restaurateurs that wanted to get out before the pandemic that got trapped, and now they're really wanting to get out. So I think that's still just seeing good restaurants, good operators. They're just old. You got restaurateurs that are in their late 70s, 80s. Their kids are retiring. There is no one to take over the business. You got to sell it. And so I think that's where, again, I think the hard part with restaurants is it's a specialty skill. And so that's where the experience comes into play. So important. Can they come in and say, food service costs are high, employment costs are high? I can come in there. Wow, this is a gold mine. If you don't know the business, you don't know.
Yeah, that's a really good point. So, Scott, where are we going in 2026? I mean, with this administration, are there going to be more stricter guidelines? How is that going to relate to potentially the interest rate coming down? Like, give us a kind of a crystal ball look at what we have to come for next year.
I think interest rates are going to continue to fall. We're not going to get back to pandemic levels, but I could see another 2 to 3 rate decreases. So somewhere prime around 6.5, maybe 6.25. So I think that's going to be a good thing for loans. I don't see them tightening up anymore. Tariffs are still a big concern. We're specifically asking tariff questions. So again, if you are in a import-export business. What does that look like in terms of tariffs? Where are your goods coming from? That's important. So I see 26 being, I think, a good year. Anytime credit borrowing costs can come down, that's a good thing for everybody.
Yeah. Patrick, what is your outlook? Does this excite you for 2026? Bigger, better deals or what?
Yeah, I mean, I think, I'm always optimistic. So you're always going to get grass is greener going forward. Scott, I have one last question for you. Are you experiencing any issues with this current government shutdown? Is that affecting you? Like, has it killed any deals? Like, is it not killing any deals for you? Like, give us a little update on that.
I think we were in the hopes it wasn't going to go as long as it's gone so far. I'm starting to experience, I have a deal that should have closed this month. It's going to obviously push. Deals are still coming in. We're still going full speed ahead, but I'm hoping that they're going to come to some sort of a fix and get it back open, because I am seeing people start wanting to transition. State guarantee program is getting discussed way more in the last 2 weeks than I've heard it discussed in the last 2 years. And so that may be a source of secondary looks at deals. Hasn't killed anything, but the longer it goes, the more it's going to be a concern.
We definitely got some warnings, from CAB, for example, and stuff that, hey, you just need to prepare your sellers to pay off any of these remaining EIDL loans that they took during the pandemic in escrow, that the avenues to recollateralize or assign the loan, those doors and opportunities have all but gone away. Can you speak to that?
Yeah, the hard part with anybody assuming an idle loan, although technically possible, they're not letting the sellers off the hook. So now you're going to be on the hook for a loan on a business you have no control over.
Yeah, no, thank you.
I don't know about that one.
No, absolutely. And we're Patrick and I and others, brokers and stuff, are taking a different approach on this too. Where from 2020 onward, I personally had plenty of success in assigning these EIDL loans, recollateralizing it. And although it was hard and long and tough, we got it done. But now it's, we definitely are prepping our sellers to say, you're not taking this with you. You need to pay it off, and it could really alter the equation of this deal as a whole. So maybe they don't want to sell right now, given they have to pay it all off. So definitely that's a different nuance to it. But yeah, the curiosity about the government shutdown and changes to the SBA staffing or timelines was on our mind. So I'm happy you touched on that. Thank you. Anything else, Patrick? Can I summarize this thing or what?
Summarize and give him the bonus question.
Yes, absolutely. I just think, one, we keep pounding this down to people's throat too. It's like, reach out to the professionals, right? So Scott is so vastly experienced in the lending world and SBA world. So reach out to him with your questions. He's looking for a deal that makes sense and that is practical and it makes sense on paper. We really gotta know that they're not gonna take a lot of risk on this. So that's really the theme I took from Scott today. But it's really nice to see that when he puts a stamp of approval on it, he 97% or more of the time gets the deal funded and gets to the finish line, which is such a high success rate. So kudos to you. I hope you can end up the year being as strong as it has been thus far, and your next year is even better. And I got a bonus question for you. Let's see. So if you, Scott, were personally the lender, it was your hard-earned dollar that you were lending, what kind of restaurant, concept, or specific restaurant, who knows, would you lend to?
It's a hard one. Sorry, I'll push back. It's not a concept, it's the borrower. A good restaurateur will always be successful. They just understand the game, what buttons to push, what levers to pull. They get it. They, through the thick and thin, they're just good at it. It's not the restaurant, it's the operator.
Okay. You stayed true to your theme, didn't you?
It's hard. It's just the operators make the deal. It just, no matter how hard it gets, they understand when to go in, when to pull back. It's operators are key to, especially restaurants. A good operator we'll lend to them every time.
I love it. That's a good theme and a good theme that you've had throughout the show or the podcast here. So we really appreciate it. Thank you so much for your time, Scott. You're a wealth of knowledge. I hope people reach out to you. You know that I'll be reaching out to you on a regular basis with all my questions. And thank you so much.
I appreciate it, Patrick. Thank you, Andy.
If you enjoyed today's show and don't want to worry about missing an episode, you can follow the show wherever you listen to your podcasts. And if you found today's episode interesting or useful, please share it with someone you think would benefit and consider leaving a rating and review.
Reviews help restaurant owners or buyers just like you discover this podcast and benefit from the important topics covered in the episodes. Your opinion matters to us as a listener, so feel free to leave topic suggestions and feedback for us, as we will use these to tailor the episodes to you and help you get the most out of listening.
Thank you all for listening to this week's episode of Restaurant Deal Making Exposed. If you're considering selling your business and would like a free consultation, reach out to Patrick and Andy at therestaurantsalesbroker.com or visit www.therestaurantsalesbroker.com to learn more.